This is Spreadsheet and Templates for Repositioning Analysis, Wealth Creation through Syndication. My name is Jeffrey Smith. This is the third video in our educational series on wealth creation, and it will be in some segments with PowerPoint presentations and screen recordings showing exactly how I use the spreadsheet to analyze a repositioning project and to generate mail merge templates. This is my standard disclaimer. This is not a solicitation of investment securities. Objectives: understand income valuation equations, explain the analysis procedures, and then demonstrate analysis procedures with a spreadsheet, then generate analysis reports for financiers and a letter of intent to submit to the seller. Income valuation basics. This was explained in the previous video. I'll briefly go through this again. We start with the annual mortgage constant and the loan-to-value ratio. These are quoted by your lender. You can then calculate the leverage to price, which is the loan-to-value ratio divided by the equity ratio. The equity ratio is 1 minus loan-to-value. Annual debt service. It is the debt present value multiplied by the annual mortgage constant. Debt coverage ratio is the net operating income divided by the annual debt service. Debt coverage margin. This is the reciprocal of the debt coverage ratio, 1 divided by debt coverage ratio. The cash flow margin, it's 1 minus debt coverage margin. Debt yield is debt coverage ratio multiplied by annual mortgage constant. It's also equal to the net operating income divided by the debt present value. This is the lender's yield on the property. If they make the loan today in the amount of debt present value and they foreclose on the loan tomorrow, then this is the yield they get on their investment. That is, the net operating income goes to the lender, and therefore that income divided by the investment is the yield to the lender. Capitalization rate. This is the debt yield multiplied by the loan-to-value ratio. It's also equal to the net operating income divided by the maximum allowable offer, or the value of the property. Gross return on equity. This is the quantity debt coverage ratio minus 1 multiplied by the annual mortgage constant multiplied by the leverage to price. This is also called the cash-on-cash return. Leverage to yield. This is the return on equity divided by the capitalization rate. It's also equal to the cash flow margin divided by the equity margin. It is the multiplier on the cap rate that you're receiving as your cash-on-cash return. Debt present value is simply the net operating income divided by the debt yield. The maximum allowable offer, or the value of the property, is the net operating income divided by the capitalization rate. It's also equal to the debt present value divided by the loan-to-value ratio. Derived capitalization rate. We start with 3 important numbers: the debt coverage ratio, the annual mortgage constant, and the loan-to-value ratio. Annual debt service is debt present value times annual mortgage constant. Debt coverage ratio is net operating income divided by annual debt service. Maximum allowable offer, or the value of the property, is the debt present value divided by the loan-to-value ratio, and that is equal to the net operating income divided by the capitalization rate. Now we rearrange this algebra and we come up with the annual debt service is NOI divided by DCR. And then if you take the annual debt service and divide it by the AMC, you get the debt present value. And if you take the debt present value and divide it by the loan-to-value, you get the maximum allowable offer, or the value of the property. Therefore, those 3 values, the debt coverage ratio times the annual mortgage constant times the loan-to-value ratio, is the divisor for the net operating income to determine the value of the property. Therefore, the capitalization rate is equal to DCR times AMC times LTV. And DCR times AMC is equal to the debt yield. Therefore, the debt yield times LTV is equal to the cap rate. The debt yield can also be derived algebraically in this equation. NOI divided by DPV is equal to the NOI divided by the quantity, annual debt service divided by annual mortgage constant. We then substitute for annual debt service the net operating income divided by debt coverage ratio. We then replace the divisors with the product of DCR and AMC, and then invert the divisor so that NOI times the quantity DCR times AMC divided by net operating income is equal to the debt yield. The NOI is on the top and bottom of the division, therefore they cancel out, and debt yield is DCR times AMC. Annual mortgage constant. Use a spreadsheet or a financial calculator that uses positive dollars received and negative dollars paid out. Set the number of periodic payments per year. Then set the fully amortizing term, the number of payments. So for a 30-year monthly payment, 30 years times 12 months per year is 360 payments. If it's 20 years, that would be 240 payments, and so on. Set the interest rate. Most calculators use an annual interest rate, and that's okay. Spreadsheets use a periodic interest rate. Set the appropriate interest rate. Set the future value to $0. This is fully amortizing. Set the present value to negative $1. This is money paid out. And you'll receive a periodic payment and $0 for a future balloon value. You calculate the periodic payment for that $1 loan that fully amortizes over the amortization term. That periodic payment represents the periodic mortgage constant. You then multiply the payment by the number of payments per year to calculate the annual mortgage constant. This is also called the annual debt constant or annual yield constant. This is the operating data from the previous example in the previous videos. We have actual operating data, how it's currently performing, and pro forma operating data, how we expect it to perform in the future once we finish the stabilization and repositioning project. Repositioning analysis. In this hypothetical case, we've determined that the anticipated project duration is 12 months. And this property has 78 rentable units. That is, they will be rentable after the repositioning project is complete. Presuming acquisition closing costs to be about 2.5% of the maximum allowable offer. There are no carrying costs because we are fitting the entire financing for this project into the current actual net operating income. Cost of repairs, we're guesstimating is $1,200 per unit. We'll know more once we get the property under contract and have a general contractor go through the property and walk every unit to determine a scope of work with cost estimates. We add a contingency factor, a fudge factor of additional 15% to come up with total repositioning costs of $127,000. Now, this property will be purchased in the name of a membership LLC, a limited liability company. And this is the summary of how that company will be financed. We start with debt reserves for 3 months, plus an equity investment in the purchase of the property, which will be 10% of the investment to value. And then we add a 4% of the ITV as a syndication premium fee. This is paid up front to the syndicator for arranging the deal, structuring it, and assigning the purchase contract to the membership LLC. The membership total funds is therefore $149,748. In addition to the syndication premium fee, the syndicator also receives a percentage of ownership in the deal. And this ownership is represented as membership units. We start with a total of 20 units, subtract the units reserved for the syndicator, that's 40% ownership, leaves 12 units available for sale. That represents the remaining 60% ownership. We therefore calculate the unit price, $12,479. calculate how much cash flow will come to the membership after servicing all expenses and the private debt that will be on this property. And the annual yield on this investment will be 17.65%. That's very good cash flow. When the property is completely repositioned and refinanced with a cash-out loan, after paying off the senior debt on the property, we'll have $387,223 remaining. We subtract 40% of that as the syndicator's share, leaving $232,334 to be distributed among the common equity investors. Now the per unit cash out is equal to $19,361. That represents a 155% return to the common equity investors. Now in terms of ratios, if they put in 100, a year later they get back 155 plus any cash flow during that year, plus they still have their ownership interest in the property and a net cash flow from that property with no cash invested. It appears to be a 10.82% yield on the retained equity, but actually is infinite because there's no cash invested in this deal after repositioning. And the cash out is tax-free if it is rolled into another real estate investment. Otherwise, it would be subject to capital gains tax when the property is sold.